Brand new revised GDP numbers just shocked the market.
The U.S. economy grew at a 4.4% annualized rate in the third quarter of 2025.
So are we living through Trump's economic boom, or is it inevitable that this is going to head for a bust? I'm going to reveal the answer to that question in 3 simple, fast steps. Step number 1, let's go over the new GDP data. These revised numbers straight up. Well, they were high to begin with, right around 4.3%. They were revised up to 4.4%. We say, oh, George, that's not revised up that much. Yeah, but our starting point was 4.3%, which is extreme growth when you consider how developed the U.S. economy is. In fact, with these revised numbers, GDP growth is at its highest level since 2023. And yes, this is real GDP, so we're adjusting for inflation. Let's look at a chart. We go from today's date all the way back to 1985. In the middle here, we got 0 up to 10%, and this is a negative 5%. Now, what I want you to notice is where we are with these red arrows. This is heading into a recession, and you'll notice going back to the late 1980s, going into the recession of the early 1990s, GDP growth declining. Same thing here at .com, same thing with GFC, and then we had an abrupt decline there with the cerveza sickness. But based on the most recent data from the BEA, editor, go ahead and put that up on the screen. And what you'll see is we're actually getting an acceleration of GDP since Q1 of 2025, where it was actually negative. Now, I know a lot of you right about now are saying to yourself, whoa, George, time out. I really don't care what this headline data says. My lived experience tells me this is far from an economic boom. Everyone I know says it's hard to get a job. It's hard to make ends meet. And this is a very valid point. So what we really have to figure out here through the rest of this video is who's correct as far as the data, because we're getting two completely different stories. One story is an economic boom, the other is an economic bust. What am I referring to specifically? Well, when you look at the real GDP, like we said, it looks fantastic. Like the economy is accelerating up, and there's no looking back, baby. We're running on all 8 cylinders. But, and here's the key, if you look at the labor market is saying that the economy is getting a lot worse. It's definitely not getting better. Step number 2, now let's go over some other very important indicators that give us a little bit different take on the overall economy. We'll start kind of right where we left off in step number 1, talking about the labor market. So this is non-farm payrolls. That's kind of the proxy that everyone uses for the health of the overall labor market. And what I want you to notice is when this blue line goes under 0, meaning you're getting negative non-farm payrolls, that's usually when you're in an economic contraction. Now, there are certain instances when you get a month or two where it's negative and then it snaps back, like you see here in 1983. You see that again in 1986. And you could argue a couple times here in the 90s, but usually that's a one-off weather event or a big national strike. Imagine a strike at Walmart, the #1 employer in the United States. That would definitely impact the non-farm payrolls, but only for a month or two. And then, like I said, it would snap back. Now, this is a chart just going to 2019, because if you show 2020, it really gets hard to read. So now let's look at what's happened more recently from 2021 to 2025, the end of 2025. And you can see that we're getting a couple negative prints. Now, this is before the revisions. So if we go over to the BLS, the last report, we can see that although on the chart we just showed, the Fred chart, for October as an example, it was a negative 108. We see here that just more recently, it was revised down another 68,000, which brings the total to a negative 173. So in fact, Jerome Powell came out and announced in a press conference that he thought the non-farm payrolls were overstating the jobs numbers by 60,000 per month.
And there's been something of a systematic overcount. And we think it's about 60,000 a month, so 40,000 jobs could be negative 20.
So if you look at the average, especially in the last 6 months of 2025, the average would have likely been negative after revisions or even by the Fed's own admission. So then we go back to that first chart where you really don't see consistent negative non-farm payrolls after revisions outside of an economic contraction, and that's where we get the head scratcher. Is it a boom when you look at GDP, or is it a bust when you look at the labor market? So let's go over some other data to help us come to a conclusion. First and foremost, we want to look at metals. So we look at gold, 4,900, over 4,900 today. Silver, it seems like it's up 4 or 5% every single day. We're getting close to 100. And then copper, Dr. Copper at 5.8. So if you look at these numbers, it definitely seems like, all right, we're in an economic boom. This backs up the very, very good GDP report that we just had. But now let's look at energy, because energy is the economy. So would we be in an economic boom if we're seeing the price of oil sub 60? Probably not. Probably not. Oh, but wait, there is more. Donald Trump himself has come out recently with some very, let's say, bold strategies on how to help the consumer. First and foremost, I'm sure you all have heard, he wants to ban corporations from buying homes. He wants to get interest rates down. Why is that? It's because people can't afford to buy homes, even though in 51% of the country, according to Zillow, we've seen price cuts over the last year. So the point here is, if the economy was booming and the poor middle class and the high end was all doing fantastically well, as you would imagine looking at just the GDP numbers, would Trump need to go to these extremes prior to midterms? And we're not done with the housing market. Let's go over to his more recent talking point, and this is trying to cap interest rates for credit card transactions. Well, who's using credit cards? Well, that would be the poor and the middle class, the people that are likely getting squeezed if you believe the labor market data. So you see what we're saying here. If you look at the metals like copper, well, that definitely backs up the GDP story. But if you look at things like what Trump is actually doing, that backs up the labor market story. But now let's move on to corporate America, where Macy's has recently come out and talked about their bold new strategy where they're trying to target the higher end consumer. And if we look at like Delta Airlines, where they're making all their money is at the high end selling first class tickets. So what this shows you is maybe the top 1% are doing well, but the bottom, let's just say 90%, they're really struggling. So now that we've looked at a lot of different data points, let's try to put all the pieces of the puzzle together and come to some conclusions about what's really happening with the United States economy. Step number 3. Now let's try to reconcile all of these data points and try to make sense of actually what is going on, the reality of the situation, and not just the narrative that you hear in the mainstream media. So we're going to start with, well, my opinion, that it's all about this. In fact, it's all about these 3 things in my view. We're going to start with the K-shaped economy. Now, most of you know what this is, but I think it's great to get a visual representation to show just how powerful this actually is. So we go from today's date all the way back to 2009. And here we go from 0 up to 6,000, actually a little bit higher here, and down to a negative 1,500. And, oh shoot, I forgot. On the right, we had some numbers that are applicable to this blue line. Editor, go ahead and throw those up on the screen, or the actual original chart. So first, let's pay attention to this blue line. This is a visual representation of the University of Michigan Consumer Sentiment Survey. And again, that's applicable to the numbers on the right, which I forgot to include. But really, it's all about the trend. So we see this going up kind of in lockstep with this red line until we get to the cerveza sickness. And then you see they go the complete opposite directions. Now, what is this red line? This red line is a smoothed out representation of, you guessed it, the S&P 500. So once we get past the cerveza sickness, consumer sentiment really plunges. In fact, lower than it was even at the depths of the GFC, but yet the stock market goes higher and higher. It doesn't go higher and higher and higher. It goes absolutely parabolic. So if you own assets during this period, or the S&P 500 using it as a proxy, well, you're like Scrooge McDuck. You're swimming around in all your gold coins. Your purchasing power has increased massively. You're out there buying bottle service. You're out there going out to eat every single night. You're buying a new car. You're going on vacations. You're flying first class, etc. Which would make sense when we look at step number 2 and see what's happening at Macy's, trying to target the high-end consumer, and the airlines saying that they're making all of their profit with those first class seats. But I don't think it ends just with the K-shaped economy. Let's think about what's happening right now with AI CapEx. So the capital expenditures, we all have heard the stories, and you've probably seen them in your backyard, of these data centers going up. They're going up like wildfire. Now, we can debate as to whether or not this is a bubble, but the bottom line is they're spending trillions of dollars on this build out for AI. That requires a lot of copper. So even if the overall economy is slowing with the exception of that one thin slice, you would not only see this picked up in nominal GDP or even real GDP, but you would also expect to see these copper prices ripping higher. But it doesn't end there. Now let's go over to this third point that I'd like to make. And I think this is key because I don't hear anybody talking about this. And I think it's a really big deal. So make sure you pay attention to this one. It's something I call the price rotation. Now, what is this? You guys all know that we have had tariffs, and I'm not going to debate whether that's good or bad, but we do know that imports into the United States have been decreasing. Okay, well, if imports are decreasing, that most likely means cheaper goods from outside of the United States. So, is it great that everyone's buying America or buying more American products? Sure. Well, it all depends on who you are. Because if you're the poor or middle class, if you're in the lower, let's say 90%, well, then what you have is a substitution. So before you were able to buy this widget A, let's say, for $1. But now that's not being imported into the United States. So your only option is to buy from a US manufacturer. Now, again, that may be good, but the bottom line is you're only going to have an option, if you want that widget, you're only going to have a $2 option as opposed to a $1 option and a $2 option. And if you think about the deflator for real GDP, remember they start with nominal GDP and then try to calculate or take out the inflation rate, and that's what gives you the real GDP or inflation adjusted number. So if that deflator is wrong, then you got a big problem, don't you? So if we just looked at this, widget B has not gone up in price. No, the deflator would be 0. But if you include the substitution, then this means that the out-of-pocket cost for the consumer is going to actually double, which would put far more pressure on their purchasing power, which is what we're seeing in the University of Michigan survey. Now, what's really interesting is if you think through the percentage of income that the rich people with assets, let's say the top 10%, spend on this substitution. Now, they only have the option of B as well, because no one has the option of A. But this is such a minute percentage of their overall income or net worth that they really don't even feel it. Because, sure, they have to pay an extra $1 for this widget, but they just made an extra $1,000 because the S&P 500 went up by 5%. So the bottom line is if we start with 5% nominal GDP and we add their deflator, and these aren't exact numbers, just using it for the sake of the example. Let's just say it's 1%. That's what takes us down to the 4% real GDP. But if you look at it in terms of the price rotation, we shouldn't be subtracting 1%. We should probably be subtracting more like 5 or 6% if we're really trying to measure the impact on the average Joe and Jane, which would take the real GDP from 4% down to, let's just say, 0%. So when you scratch beneath the surface, you look at the K-shaped economy, you look at what the AI CapEx spend is doing to not only real GDP growth, but also some of those metals like copper that have gone straight up. But when you look at the labor market, it's that head scratcher. And then you combine that with this price rotation that has put even further pressure on the bottom 90%, where the top 10% don't even feel it. And then you calculate that into real GDP, it makes a lot more sense. So to answer the question, are we seeing Trump's economic boom or an economic bust? I would say both. It all depends on who you are. And on that bombshell, guys, I'd like to make a huge announcement. We have just started selling tickets to Rebel Capitalist Live 2026. This is the annual investment conference that I put on in Orlando, Florida, and especially for 2026, this is an event you don't want to miss. We'll go ahead and put a link in the description below where you can see all of the speakers, past speakers, and you can buy your tickets ASAP. Because I'd like to remind everyone that as we get closer to the event, the ticket prices go up. So if you buy your ticket right now, you're going to lock in the lowest price possible. So again, the link is in the description below so you can get your tickets to Rebel Capitalist Live 2026, and I will see you in Orlando.